In February 2026, Stellantis posted the worst set of numbers in the company's history, a record €22.2 billion in write-downs and charges, its first annual loss ever, a stock that fell 25% in a single trading session. And buried inside that same earnings season, almost nobody outside the industry noticed the number moving in the opposite direction. A Chinese EV startup most of the West had never heard of had just posted its first ever annual profit on sales that had doubled in 12 months. Both numbers trace back to the same $1.6 billion handshake, signed 3 years earlier, that almost nobody took seriously at the time. So how does a company nobody in Detroit or Turin could name end up quietly propping up one of the biggest car makers on earth? You have to go back to two very different kinds of desperation. Leapmotor was founded in Hangzhou in 2015 by Zhu Jiangming, an engineer who'd made his money co-founding a Chinese surveillance camera giant before deciding cars were the bigger opportunity. The company didn't ship its first vehicle until 2019, 4 years after the doors opened, into a Chinese EV market already crowded with dozens of well-funded rivals fighting over the same buyers. By 2022, Leapmotor had sold about 111,000 vehicles. That was enough to rank it 9th among Chinese EV makers. 9th out of dozens. A rounding error next to BYD, a footnote next to Tesla, a name that meant nothing to a single car buyer outside China. Stellantis had its own problem, and it was arguably worse. Formed in 2021 out of the merger between France's PSA Group and Fiat Chrysler, the company controlled 14 brands and sold cars on almost every continent except the one that mattered most. In China, the world's biggest auto market, Stellantis held roughly 0.3% market share. Not 3%, 0.3%. The company had just shut down its joint venture with Guangzhou Automobile Group, the one that had spent years building Jeeps almost nobody in China wanted to buy. It was sold internally as a strategic reset. It was actually a decade of losses finally getting written off. 2 companies, one invisible in the West, one invisible in China. Neither had any obvious reason to need the other. On October 26, 2023, Carlos Tavares flew to Hangzhou and stood next to Zhu Jiangming to announce that Stellantis was buying a 20% stake in Leapmotor for $1.6 billion, about €1.5 billion. The 2 companies would form a new joint venture called Leapmotor International, with Stellantis holding a controlling 51% and Leapmotor holding the remaining 49%. That's a joint venture where one partner holds enough votes to steer the strategy, and it mattered here because Stellantis wasn't just writing a check. It was buying the exclusive right to build, distribute and sell Leapmotor's cars everywhere outside China. For a while, it looked like exactly the kind of move that pays off slowly and then all at once. Through 2024, Leapmotor International opened dealer relationships across Europe, putting the compact T03 and the C10 crossover on the same showroom floors as Citroën hatchbacks and Fiat 500s, with local assembly plans taking shape at Stellantis' own Zaragoza plant in Spain. One European dealer, watching a customer cross-shop a Fiat 500 against a Leapmotor parked 10 feet away, put it simply, buyers had stopped caring which badge sat on the hood. By the end of 2025, Leapmotor had planted flags in 40 countries, with more than 900 sales and service outlets, over 800 of them in Europe alone. Global deliveries hit 596,555 vehicles for the year, more than double 2024's total. State-owned automaker FAW bought a 5% stake of its own that December for $3.74 billion, a fresh vote of confidence from Beijing. And for the first time since Zhu Jiangming opened the company's doors a decade earlier, Leapmotor turned a profit. Only 538 million yuan, about $78 million, but a profit. For a while, it looked like the smartest $1.6 billion Stellantis had ever spent. Nobody thought so at the time. The day the deal was announced, Leapmotor's own stock dropped 11%, as existing shareholders priced in the dilution of a fresh $1.6 billion investor suddenly owning a fifth of the company. Stellantis shares barely moved, down 0.5%, because almost nobody on Wall Street or in Milan thought the deal was significant enough to react to. That reaction wasn't an accident. it was a read on the choice itself. Tavares hadn't gone after China's biggest EV maker. He'd passed on BYD, the runaway market leader, and on NIO and Xpeng, the startups already chasing premium buyers. He picked the 9th-ranked player instead, a company small enough that Stellantis could still be the senior partner in the relationship, rather than a junior distributor taking whatever terms a giant like BYD chose to hand it. Analysts weren't kind about it. The deal got described as a hedge, a distraction, a tacit admission that Stellantis had given up trying to out-engineer China and had settled instead for renting a seat at its table. Tavares saw it differently and said so publicly at the announcement. The Chinese offensive, he told reporters in Hangzhou, was visible everywhere in the industry, and Stellantis could either keep losing to it or find a way to benefit from it instead. Buying into Leapmotor was his answer, made at a moment when almost no one at his own company, or outside it, believed it was the right one. Zhu Jiangming, for his part, had his own reasons to say yes. A Western distribution network and a foothold in Europe that Leapmotor, alone, would have needed years to build from scratch. The man who made that bet didn't stick around long enough to find out if he was right. Tavares had built his turnaround plan on aggressive cost-cutting. Cheaper plastic parts replaced durable ones. The Hemi V8 got killed off entirely. Prices climbed even as US dealers watched inventory pile up on their lots. By September 2024, American dealers were criticizing him publicly, something almost unheard of in the industry. Stellantis stock finished 2024 down 43%. In the same 12 months, General Motors was up 55%. Ford was down only 9%. But they had no way of knowing in that moment that the deal Tavares had signed a year earlier in Hangzhou would end up outlasting him by years. On December 1st, 2024, Stellantis announced that Tavares was leaving with immediate effect, citing differing views between the CEO and the board, nearly 18 months before his contract was even due to expire. It wasn't framed as a firing. It functioned like one. Chairman John Elkann, who reportedly gave Italy's Prime Minister a heads-up before the news broke, stepped in to lead an interim executive committee while the board searched for a permanent replacement, a search that would take 6 months. Unions on both sides of the Atlantic, the UAW in the US and Unifor in Canada, had already been building pressure of their own, over plant investment and job cuts, one more front in a 5-year run that had started to look less like a merger integration and more like a slow-motion mutiny. Inside Stellantis, the search for a new CEO consumed the company's attention. Outside it, in Hangzhou, Leapmotor kept building. The company that had looked like an afterthought in Tavares' own turnaround story was quietly becoming the healthiest part of it, even as the man who signed the deal had already walked out the door. Whatever Stellantis had built with Leapmotor, it wasn't building it in a vacuum. Chinese EV makers weren't waiting for Stellantis' blessing to come to Europe. More than 40 Chinese EV brands were already fighting for market share there. Part of a price war Tesla itself had triggered back home with repeated cuts to the Model 3 and Model Y. By the end of 2025, China-made vehicles accounted for more than 9% of new car sales across the EU and over 20% in the UK. BYD alone was selling more cars globally than most legacy brands combined, and had set its sights on moving well over 1 million vehicles overseas in a single year. Even with Leapmotor in its corner, Stellantis' own EU market share kept sliding, down to roughly 16% by mid-2026, proof that one Chinese partner wasn't enough to fully offset dozens of Chinese competitors. Then came the tariffs. The European Union had already imposed additional duties on Chinese-made EVs to slow the flood. Leapmotor, distributed through Stellantis' own European network, rather than shipped in as a finished import, was structured in a way that softened some of that exposure. But the bigger threat sat across the Atlantic. Starting in 2027, vehicles running connected systems linked to Chinese software would be banned outright from import and sale in the United States, the single market Stellantis needed most to fix. That meant whatever Stellantis was building with Leapmotor's technology might never be allowed anywhere near American roads, the exact market where Jeep and Ram were bleeding share the fastest. A partnership built to solve one problem was running straight into a wall built by an entirely different one. Back in Turin, the company Tavares left behind wasn't recovering. It was unravelling further, The board's 6-month search finally landed on Antonio Filosa, a Stellantis veteran who'd spent the previous months as chief operating officer for the Americas, trying to repair the dealer relationships Tavares had shattered. Filosa officially took over as CEO on June 23, 2025, inheriting a portfolio struggling almost everywhere. Lancia's relaunch had gotten off to a sluggish start. DS Automobiles and Abarth weren't flourishing either. Rumours swirled about selling off Maserati entirely, rumours the company denied but never fully killed. Then, in early February 2026, came the number that defined Filosa's first year in charge. A record €22.2 billion in write-downs and charges as the company scaled back its EV strategy, driving Stellantis to its first annual loss in company history. The stock fell 25% on February 6th alone. What almost nobody outside the finance pages noticed was quieter, and in hindsight, far more revealing. Somewhere in that same stretch, Stellantis' own 20% stake in Leapmotor had already been diluted down to around 15%. Pieces of it sold off to help fund the very restructuring that was now bleeding the parent company dry. The company that once looked like the disciplined adult in the room, quietly buying a stake in an obscure Chinese startup while everyone else scrambled, was now the one that needed saving. And it was about to lean on that startup harder than anyone expected. The reversal came into public view on February 26, 2026, just weeks after the record loss. Reuters reported that Stellantis was in early talks to go far beyond simply distributing Leapmotor's finished cars. It wanted access to Leapmotor's actual battery and EV powertrain technology, the underlying engineering, to build cheaper electric vehicles under its own struggling brands: Fiat, Opel, and Peugeot. A deal that had started in 2023 as an equity stake and a distribution agreement had, within roughly 2 years, quietly become something closer to the technological backbone of Stellantis' own electric vehicle strategy. Filosa confirmed the shift himself. He called the technical partnership essential to competitiveness in electric vehicles and important for Europe as a whole, and described 2025 as a year of strategic implementation that had set the stage for deeper integration between the two companies going forward. This was no longer a Chinese startup selling budget hatchbacks alongside Fiats on a European showroom floor. This was a struggling 14-brand legacy automaker, the product of 2 prior mergers and billions in write-downs, effectively outsourcing part of its electric vehicle roadmap to the 9th-ranked player it had once been mocked for choosing. Using Leapmotor's systems could save Stellantis billions in development costs it could no longer afford to spend twice. It could also let the company move faster against BYD and MG than building everything from scratch ever would. The deal nobody had taken seriously in Hangzhou in 2023 had just become the closest thing Stellantis had to a functioning EV strategy. It wasn't that simple, and Stellantis knew it. Talks over sharing Leapmotor's battery and powertrain technology were still at an early stage, with real hurdles unresolved: data protection concerns around Chinese-linked software, and that looming 2027 US ban on vehicles running connected systems tied to China. Whatever Stellantis built on Leapmotor's platform might be locked out of the one market where Jeep and Ram needed the help most. In May 2026, Filosa used Stellantis' Capital Markets Day to lay out the next phase, a roughly €60 billion plan called Fastless 2030, with the Leapmotor relationship built into its foundation rather than treated as a side project. The same month, Stellantis struck a second separate China deal, a $1.17 billion expansion of its old Dongfeng partnership, to build new Peugeot and Jeep electric vehicles at a Wuhan plant starting in 2027. Weeks later, Bloomberg reported that Stellantis and Leapmotor were even discussing building EVs together in Canada, while CKD assembly of the Leapmotor C10 got underway in Malaysia, a supporting battery pack plant in Spain aimed for mass production by July, and a B10 crossover launch readied for the Zaragoza line that fall. There was even talk of handing the Madrid plant over to Leapmotor outright, a legacy Stellantis factory potentially run, in part by the partner it had once treated as a side bet. It wasn't hard to see the pattern. What began as one contrarian bet on a small Chinese startup had turned into a broader strategy of leaning on Chinese partners across nearly every corner of the portfolio. One industry analyst put the open question bluntly: whether all this Chinese engineering ends up strengthening Stellantis' own brands, or slowly replacing them, is a question nobody at the company has fully answered yet. As of this summer, the numbers keep pointing in one direction for Leapmotor and a murkier one for Stellantis. Leapmotor delivered over 110,000 vehicles in the first quarter of 2026 alone, its fourth straight quarter above the 100,000 mark, then posted a third consecutive monthly delivery record in June, pushing first-half deliveries to 356,487, up 60.8% year-over-year. It's chasing a target of 1 million vehicles for the year, roughly double what it sold in 2025. The Leapmotor International joint venture's own European revenue crossed €1 billion for the first time. Its stock has cooled off from a 52-week high above 76 Hong Kong dollars to the low 40s as of this writing. But that's still a market cap north of $7 billion for a company most of the West had never heard of when Stellantis signed the check. By the time you're watching this, Leapmotor may have already reported another quarter nobody expected. Whether Stellantis itself has turned the corner is a different question entirely, and Filosa still hasn't fully answered it. The write-downs are real. The dealer anger hasn't disappeared, and the company is now betting a meaningful piece of its future on technology it doesn't fully own, built by a partner it once treated as an afterthought. The lesson here isn't really about Stellantis, or even about Leapmotor. It's about what happens when a company that built its entire identity on making cars finally admits it can't out-engineer its biggest rival, and decides the smarter move is buying a seat inside their factory instead. Sometimes the sharpest move a legacy automaker can make isn't building a better engine, it's admitting somebody else already built one. Stellantis isn't the only legacy brand quietly outsourcing its future to a Chinese partner right now. In the next video, we'll look at one that's already gone even further down that road than anyone at the company will publicly admit.